Hello everyone, this is Assistant Professor Sushmita Pathak from Lakshmi Chand Golbala College. Today our topic for the session is study of financial statements from the subject Management Accounting or Managerial Decision Making from the program SYBCom, SYBAF, SYBFM and SYBMS. Before starting with the session, I'll brief up about the session, what we're going to do throughout the session. So first we'll see the management accounting, what is the meaning of management accounting, then what is financial statements, what are the different formats of financial statements, what is vertical financial statements, and the last we'll do the pro forma of vertical balance sheet. So let's get started with the meaning of management accounting. As in your 11th, 12th and FY, you have heard only one accounting, that is financial accounting. But now from SY and TY, you will see two more accountancy, that is management accounting and cost accounting. So the management accounting, the term consists of two words, management and accounting, which means you have to do accountancy for management. Here management is going to make a sound financial decisions by looking, identifying, measuring and analyzing the accounting informations which was there in the financial accounting and cost accounting. Why management accounting have to identify, analyze, interpret the accounting information? Just to take a sound decision, sound financial decision and creation of policy, and also it help us to meet our day-to-day operations very effectively. So just for sound financial decisions and managing our day-to-day operations efficiently, effectively, management look into the accounting informations, management analyze the accounting informations, management measure the accounting information, and from this information, from this help, management make a sound financial decisions so that we can meet our day-to-day operations, and as well as it will help us to create an policy. Management accounting is also called as managerial accounting. So in short, it is nothing but a process where a management or a leader or a manager has to identify, has to analyze, has to interpret the accounting informations which were recorded in the financial accounting and cost accounting. With the help of these accountancy, they have to make a sound financial decisions efficiently, and they have to manage the day-to-day operations effectively. So by this they do management accounting. So management accounting is much more importance, it consists importance same for financial as well as cost accounting, because if you fail to create an efficient policy, if you fail to create a sound financial decisions, your business will never be a boom process. So just if you want to enhance your profit, enhance your sale, you need a branding, you need a good reputation. It is important that you should make a sound financial decisions, and also it is very much important that you should meet your daily operations in an efficient manner so that you can reach your goals and objectives. So management accounting nothing but help us to make a sound financial decision, to create a effective policy, and also to manage our daily operations efficiently by identifying, analyzing, interpreting the accounting informations which were already recorded in the financial accounting and cost accounting. Next, study of financial statement. What are the different statements we study? I guess you all are aware about balance sheet, income statement and cash flow statement. this is the same process, or this is the thing you have done from 11th, 12th and FY, where you have done the financial statements. So what is financial statements? Balance sheet, income statement, which is also referred as we referred as profit and loss account, and third we have cash flow statement. So in this chapter we are going to focus on balance sheet and profit and loss account. Now, format of financial statements. So there isn't two format for making a financial statement. First is conventional format or horizontal format or T format, which we're doing from 11th standard. Here you have to make for balance sheet liabilities amount, asset amount, and for profit and loss account particulars amount, particulars amount. This is our traditional method which we followed from 11th standard only, which is called as conventional, horizontal and T format. This is nothing but an traditional format which is present as a T. If you look at the format, it will present as a T. So balance sheet, in left hand side balance sheet indicates the liabilities, and in right hand side it indicates the asset. Same goes to P&L account, that is profit and loss account, where left hand side indicates the expenses and right hand side indicates the incomes which you have earned for a specific period. So yeah, conventional format, horizontal format and T format, which is our traditional format only. Now what is important in this chapter is vertical format. You have to learn what is vertical format, how you have to prepare your vertical format. The items which consist in your old format, that is your traditional format or T format, same item consists in the vertical format only. There is no changes in any items recorded in balance sheet and P&L account, but there isn't change in format, as vertical format is much more suitable as compared to our traditional, that is T format, for analyzing financial things, analyzing ratio, analyzing comparative things, which we can do in further in our. So vertical format or financial statement is much more suitable for financial analysis, especially for ratio analysis, comparative analysis, trend analysis, common size analysis, which is convenient as compared to our old or traditional format. In the next slide we're going to see what actually the vertical format is all about. First we'll see the importance of vertical balance sheet. Why our vertical balance sheet is important, why we can't make in traditional format, why there isn't switch in the format. So vertical format of balance sheet, it does not demonstrate our financial position, but it shows the flow of fund in a year. As we have already noted that we make or prepare a balance sheet for a year, so vertical format is nothing but it shows the flow of your fund throughout the year, which creates our balance sheet in such a shape so that you can get an exact position of your funds, that is where you have invested. Say for an example, if you have invested in certain current assets, if you have invested in fixed assets, if you have invested in the investment, so by preparing a vertical format you will easily get to know where you have invested your funds and where you have to avoid if you want to continue your business to another year. So by looking your previous year vertical format, here you can get an idea where to invest and where to invest now. Moreover, most of the companies today are depending on the vertical format for reporting. Why? Because it has a proper shape where balance sheet shows an exact position as compared to our horizontal, that is our traditional format. So this is why vertical format is much more important as compared to our traditional format. Abhi what consists in vertical balance sheet, we'll see what are the basic things which consists in vertical balance sheet. What you have to prepare, what are the items to be there in the vertical balance sheet. So there are two parts, application of funds and we have the sources of funds. First we have is sources of fund, then next we have is application of funds. So it is much more important, focus on this here. Like for any business, if you want to start a new business, it is important for you to generate funds. You can't be rely on borrowed funds only. You have to generate funds from yourself only. So first thing is important for opening any business, or if your business is old but you have started a new project. So for new project you required finance, right? So for finance, this is nothing but a generation of funds which named as sources of funds. So in balance sheet, first point we have is sources of fund, from where you generate funds so that you can invest in your business and your business can run smoothly. So what are the different sources? First we have is owned fund, that is our fund, which is nothing but an equity share capital and preference share capital, where what you have to do is you just have to release a shares in the market so that public can buy your shares and you can get your fund. Next one we have is reserves and surplus, which is nothing but you have, if your business is old and you want to start your new project, so your old business there must be a certain reserves. So reserves and surplus is also your own fund. This is your own fund, this is which was generated by you only. The next we have is borrowed funds. यहाँ पे what you do is you have taken loan from any financial institutions. Here the borrowed fund is nothing but a long term loans. Here we are not talking about the short term loans. Here we are only focusing on the long term loans. So borrowed fund is nothing but a long term loans which were taken from financial institutions or any bank. So this is our first part, sources of funds. Sources of fund is nothing but a fund for finance where you collect. Then next we have is application of funds. The funds you have collected, the sources of funds. So sources of fund is nothing but a generation of funds from where you generate money, from where you generate your funds for investment in your business. So first point is important, that is we have to focus on the generation of our funds. Whether your business is old, you are starting a new project, or whether your business is new, you are starting a new business. So first of all, it is important that you have to generate your funds. So there is a two way you can generate your funds. First we have is own capital, and second one is we have is borrowed funds. Own capital is nothing but an issuing equity shares and preference shares in the market. And also if your business is old but you are starting a new project, so you can reserve some money which is used as your own fund. Next we have is borrowed fund, where we are talking about the long term loans, long term borrowings. Here short term borrowings are not there. Borrowed fund, here we are focusing only on the long term funds. So this is the source where we can generate our money. This is our first step for making our vertical balance sheet. Second we have is application of funds. If you have generated your funds, if you know the different sources for generation of your funds, the next step is important, that you have to apply in a very efficient manner. Only if you are generating your funds is not enough for running your business or for running any project. The thing, sources of fund is important, same your application of fund is also important. So for application of funds we have three parts: fixed asset, long term investment and working capital. Working capital is nothing but an current asset minus. So now we have done with our first steps, that is generation of funds or sources of funds. Now we'll move to our another step, that is application of fund. Sources of fund and application of fund, both the things consist equal importance. If generation of fund is important for you, same goes to an application of fund, because you know where to invest, where to apply your funds, so that your business can run smoothly, can run efficiently, can run effectively. So for application of funds, we have three items. First, fixed asset. Second, we have long term investments, and third we have is working capital, which is working capital is nothing but current assets minus current liabilities. So these are the three things where you have to apply your funds, so that your business can run efficiently or effectively. So this is all about for vertical balance sheet. This is the item which consists in your vertical balance sheet. We'll see the proper pro forma of vertical balance sheet, how you have to make a balance sheet in an proper or in an appropriate manner. So first we have is just look at the pro forma, the previous pro forma or the traditional pro forma. What we do is liabilities amount, asset amount. We have to prepare like this: liabilities amount, asset amount. This is what, this is your T format or conventional format or horizontal format. But now we'll see the vertical format, which is our new format. So the format is particulars, amount, amount and amount. That's it. You don't have to write asset amount, liabilities amount. You just have to write in pro forma particulars, amount, amount and amount. So first thing you have to write is total funds employed or sources of fund. As I have already told you, the first step for any startup of your business or any startup project is collection of your funds. From where you can collect your funds, what are the different sources from where you can generate your funds. So first we have is shareholder funds, or we can say owners fund or proprietors fund. Proprietors fund, proprietor is nothing but an owner. Then shareholders fund is also an owner's fund. So first we have is capital, where we are going to write equity share capital, preference share capital, less unpaid calls. If in your sum is there any unpaid calls, so you just have to less from equity share and preference share capital. And afterwards, if there is mention of forfeiture of shares, you just have to add the forfeited shares. So first step for calculation of this is total funds employed or sources of fund. In this you have to write shareholders fund, owners fund and proprietors fund, where first item is there equity share capital, then preference share capital. If any unpaid calls are there, less the unpaid calls. If any forfeited shares are there, add the forfeited shares. After all this, you just have to total in the second column. See, in first column you have written equity share capital amount, preference share capital amount, unpaid calls, forfeited shares. And in the next column, what you have done, you have done the total of what? Equity share capital, add preference share capital, less unpaid calls and add forfeited shares. So what will be the total? You just have to write in the second amount column. Next we'll move to our second owner fund is reserves and surplus. As I have already told you, कि if your business is old but you want to start a new project, so for starting a new project it is important or it is a basic thing where business reserves some amount, reserves some. So for any business, if your business is sold but you want to start a new project, what a business do is they reserve some amount of profit for future use. So reserves and surplus is also our fund, our owner's fund. So add reserves and surplus, where you have to add reserves and surplus. So there are many reserves and surplus, like profit and loss. If profit and loss account has a credit balance, you have to add in reserves and surplus. Then we have general reserve, capital reserve, capital reserve, redemption reserve. There are n number of reserves. You just have to add all those reserves, write down the amount in the first column, and the total will be shifted to the second column, total of reserves and surplus. Then next we have is less losses and fictitious asset. Abhi this is something new which I have not told you earlier, that fictitious asset, this asset you just have to less the asset. What is the asset is all about? When you start a new business, there are certain expenses, there are expenses incurred while starting a business. Say for an example, you have done some registration, so there occur an expense. Then you have done some logo, there may be some pamphlets you are distributing, there may be some hoardings. So these are the expenses which occurred when you start your business. So you just have to less those expenses. If profit and loss account has debit balance, write down in losses and fictitious assets. Then preliminary expenses, same, the expenses which were incurred while starting our business, and miscellaneous expenses. So these are the expenses when you start a new business, when you start a new project, you incurred some expenses, so you just have to write down over here. So same, write down the amount on the first column and the total amount will be on the second column. Now what you have to do is you have to calculate your net reserves and surplus, from where you can calculate by subtracting reserves and surplus from losses and fictitious asset. What you can do is reserves and surplus minus losses and fictitious asset, you will get your net reserves and surplus. Now next you have to calculate your own funds, or it is also called as net worth. So how you can calculate your own funds? The total of your capital, add reserves and surplus total amount, less losses and fictitious asset, so you will get your own funds or net worth. So this is the part where you have to calculate your owner's fund. Next part we have for generation of funds or sources of fund is loan funds. Now what is loan funds? Where you take a loan from any financial institutions or from any bank. So what are the different types of loan? There is a long term loan, debentures or bonds, debentures issued by a private company and bonds issued by a government company. Both do the same work. Debentures and bonds are same, but debentures can issued by only private company and bonds can be issued by only government company. Next we have loan from bank and any financial institutions. Here you just only have to record the long term borrowings or long term loans. So write down amount on the first column and add it to the second column, and the last you will see the line total funds employed or capital employed or total. So this is your total, as you have done in your traditional thing where you have to match your total. Your balance sheet must be tally. So this is the part which matches our application of funds total. This is the total of your sources of fund which matches the application of funds total. If both the total match, it means your balance sheet is tally. Here also you have to tally your balance sheet. So from where you can tally your balance sheet? By totaling the sources of funds and by totaling the application of funds, you get a tally. So how to total the sources of funds? To total funds employed or capital employed. Here what you have to do is own funds, which where we have already calculated own funds on net worth, add owed funds, OWED, that is your loan funds. own fund, add loan fund. So you will get your total, that is total funds employed or capital employed. I'll brief you about the things again. So we'll quickly do again. First, total funds employed or sources of funds. In this you have to write shareholders fund, owners fund or proprietors fund. Then your capital, that is equity share capital, preference share capital. If is there any unpaid call, less the unpaid call and add the forfeited shares. Write down all amount on the first column and total it in the second column. Total means equity share capital, add preference share capital, less unpaid calls if any there, and add forfeited shares if there. Then write down in the amount section. Next we have is add reserves and surplus. Reserves and surplus is also our owners fund, where you have to write down the reserves. Profit and loss, if profit and loss account has credit balance, add over here general reserve. Now add reserves and surplus. Profit and, if your profit and loss account consists credit balance, it was already mentioned in your sum only whether your profit and loss account has a credit balance or debit balance. If your profit and loss account has a credit balance, add in reserves and surplus, then general reserve, capital redemption reserve, etc. There are n number of reserves you just have to mention over here. Write down every amount in the first column and total it in the second column. Third we have is less losses and fictitious asset. These losses is nothing but a losses which were incurred during opening of your new project or opening of your new business. It is nothing but an starting expenses which were incurred. So if your profit and loss account has a debit balance, write down in losses and fictitious asset. Then preliminary expenses, miscellaneous expenses, same, write down the amount in the first column, total it in the second column. Now we have to find out our net reserves and surplus. So by subtracting reserves and surplus from losses and fictitious asset, you will get your amount, that is net reserves and surplus. Now next we have is own funds. So on how you have to calculate the own funds: capital plus reserves and surplus minus losses and fictitious assets. From this you will get your own funds. Now we'll move to our second sources of fund, that is loan fund or long term borrowing or borrowed fund. Both has the same meaning, you just have to record your long term borrowings. So we have long term loans, debentures and bonds, loans from bank or any financial institution or other loan. Same, the amount goes to in the first column and the total will be there in the second column, total of your loan funds. Now the final part for sources of fund is total it. So the thing name is total funds employed or capital funds. So how you have to calculate your total funds employed, capital employed funds: own funds plus owed funds. Own funds plus owed funds. Owed funds is nothing but a loan fund. So own fund plus loan fund, you will get your total of sources of fund. Now we'll switch to our another part, that is application of funds. So after we have done our sources of funds part, we'll move to our application of funds. So first we have, as I have told you, that first we have to invest in fixed asset. So there is an separation, there is a segregation of fixed asset. First is intangible asset, second one is tangible asset. Intangible asset is the asset which we can't touch, which we can't see, which we can't feel, but they worked as an asset. So here we have an example: goodwill, patent, trademark, design, copyright. These are the things which is an intangible asset, which you have to same write in the first column your amount and total it in the second column. Now we'll move to a tangible asset. Tangible asset is the asset which we can touch, which we can see, which we can feel. So these are the land and building, leasehold, plant and machinery, furniture and fitting. These are the tangible assets. Write down the amount in the first column and total it in the second column. So from this you will get your total fixed assets. What is total fixed assets? Intangible assets plus tangible asset. This is total fixed asset. Next we have is long term investments. First part is over for application of funds. Second part is long term investment. Whatever the investment you have done in your business, write down over here. Investment in government securities, shares, debentures, etc., any immovable properties, write the amount in the first column and total it in the third column. Then third part we have is working capital. In working capital, I have told you there is an current asset and current liabilities. What you have to do is current asset minus current liabilities, you will get your working capital. So there is an segregation again for current asset, quick asset and non-quick asset. Quick asset, in quick asset we have cash and bank, debtors and bills receivable, and in non-quick asset we have stock, prepaid expenses, advance tax and advance payments. These are the things which comes under the quick asset and non-quick asset. Same, write down the amount in the first column and total it in the second column. Next, what we have to do is total the current asset. What is current asset? Quick asset plus non-quick asset. Those are the asset we have to total it. So total it and write down in the second amount column. Then next we have is total current liabilities. Same, in total current liabilities we have quick liabilities and non-quick liabilities. In quick liabilities there are item consist creditors, bills payable, advance received, outstanding expenses, accrued interest, proposed dividends. These are the things which comes under quick liabilities. Write down the amount in first column and total it in the second column. Then next we have is non-quick liabilities, bank overdraft, income received in advance. These are the non-quick liabilities. Same, write down the amount in first column and total it in the second column. Now you have to calculate your total current liabilities. So how you gonna calculate your total current liabilities? By adding quick liabilities into non-quick liabilities. Quick liabilities plus non-quick liabilities, you will get your total current liabilities. So from this we'll get our working capital. So working capital is nothing but an current asset minus current liabilities. So we have already get the total of current asset and current liabilities. So what you're gonna do is write down net current asset or total working capital, where you have to less current asset total minus current liabilities total and write down in the second amount column. So our final step is you have to calculate your total funds employed or capital employed. As I have already told you in the sources of fund thing, you have to calculate. In sources of funds we have calculated our total funds employed. This must be tally, that is your capital employed, your total of sources of funds and total of application of funds must be tally, then only your balance sheet will be right. So how you have to calculate in application of fund is fixed total of fixed assets plus total of investment plus total of working capital. By adding all these three, you will get your total funds employed or total of application of funds. If your total of sources of funds and total application of funds matches, it means your balance sheet is tallied. So done for this session. I'll glance again what we have done in the session. So first we have done the meaning of management accounting, where we have seen there are two words, that is management and accounting. Management accounting is nothing but an accountancy for management, where management identify, measure, analyze, interpret the accounting informations which were recorded in the financial accounting and cost accounting. By helping with this, what management do is make a sound financial decision and efficiently manage their daily operations. The next we have seen study of financial statements, where what we're gonna study is balance sheet, income statement and cash flow statements, where our main focus is on balance sheet and income statement. And also we have seen the format of financial statement, the traditional format which were followed from 11th standard only, and the new format, that is vertical format. In traditional format we have to prepare balance sheet like this: liabilities amount, asset amount. But in vertical format you just have to prepare like this: particulars, amount, and amount. But both the balance sheet must be tally, that is your traditional balance sheet as well as your vertical format. Both the statement must be tally, then only your balance sheet will be correct. Then what is the importance of vertical balance sheet? That vertical balance sheet does not demonstrate the financial position, but it shows the exact position of your funds, how much funds you have invested in a certain items. So in vertical format, this is the best format for business. Even moreover, in today's thing, many companies are using it. Then we have seen what are the things consist under vertical balance sheet. So sources of funds, application of funds. In sources of fund we have seen owners fund, that is equity, share capital, preference share capital, and reserves and surplus. In borrowed funds we have seen there is a long term borrowings. Next part is application of fund, where you have to apply your funds into three parts. First is fixed assets, second is long term investment, and third is working capital, which is nothing but an current asset minus current liabilities. And after that we have seen the pro forma. As you can see in the pro forma, if I ask you, okay, tell me the reserves and surplus of your company, it is very easy for you. By looking in your format you can get to know okay, how much reserves and surplus you have, how much loan you have taken, how much investment you have done, what are the liabilities which you have to repay. So that's why vertical balance sheet is much more important and much more suitable for the position you know in your business as compared to a traditional or horizontal format. So done for the session. In the second session we'll see the vertical income statement, what is vertical income statement, and how we have to form the vertical statement. Thank you.